Welcome back to the Wealth Builder podcast. My name's Nick Donato, and I'm a financial advisor at Guidance Financial. Over the past decade, we've seen crypto and digital assets evolve significantly. Initially, when they came onto the scene, you heard of people buying pizza with their bitcoins or doing other more black market things with this new currency, to now the BlackRocks and the Fidelities of the world offering specific crypto ETFs to invest in. So today, with the help of James Brannan from Blockbite Capital, we're going to take a step back to discuss the basics of crypto and digital assets. What are they, how they work, and debunk a few myths. Thanks for joining the podcast today, James. How are you going?
Yeah, doing well, Nick. Good to be here. And just got back from Adelaide last week. And it's good to be back in Melbourne now that it's not 45 degrees anymore.
Yeah, 45 was a bit tough, but we'll see how we go with the next couple of days. But James, for the viewers, did you want to tell us a bit about yourself and what you do in the crypto space?
Yeah, sure. So my background is in the strategy consulting field. So I spent a decade working in consulting with major banks and payment companies like ZipPay. In 2021, left and joined a company called Stacks, facilitated the first IPO in Australia, where the capital raise was done entirely through stablecoins, which is a type of cryptocurrency pegged to the US dollar.
And we'll
And
get into what stablecoin is in a bit.
just over 4 years ago, we started out in a renewable Bitcoin mining space. Again, more words to break down there in a moment. As of today, we offer full suite brokerage, insured custody, and research analytics for clients in the digital asset space.
Love it. You sounds like you're an expert in the field, and you can definitely help us break down some of that jargon and help explain to the audience what exactly crypto and digital assets are. So yeah, jumping in, everyone's heard of crypto, whether it's Bitcoin, Ethereum, meme coins, whatever it is. But what is actually crypto? What are they?
Yeah, crypto is a bit of a loaded term. So it's short for cryptocurrency, and cryptocurrency itself is actually a bit of a misnomer. So in order to be considered a currency, it has to be accepted as legal tender, or that you can pay your taxes in it. And so pretty much most cryptocurrencies aren't actual currencies. But really what cryptocurrencies are a way of sending value across the internet, traditionally through blockchains or distributed ledgers. Distributed ledger simply means that multiple different computers at once have got a record of who owns what, and that's secured through encryption technology. And that's computers that ensure that only the intended recipient of a cryptocurrency is the one receiving it. And so hence the term cryptocurrency. It's a way of sending value securely from one person to another across a blockchain.
Right. So some of these so-called cryptocurrencies should really be referred to as digital assets.
Yeah. So over the last few years, the industry is sort of coalescing more towards the term digital assets because, yeah, we want to get away from the term currencies as much, at least, for the time being, I think, until we've got clear understanding of which ones are currencies and which ones aren't. Stable coins, which we briefly touched on the intro there, are the most similar to currencies today. So those are a type of digital asset where the value is traditionally it's pegged to could be the Australian dollar or US dollar, and that's a type of digital token that is issued, and then the issuer has to hold cash or cash equivalents in reserves. So that means at any point in time, if you wanted to dispose of your stablecoin, which is just a dollar on the blockchain, you could redeem that one for one back into traditional cash.
Right. And who issues the stable coins?
So the main issuer today is a company called Tether. There's other ones like Circle, Ripple have also got their own stablecoin. And there's some more local players emerging in Australia as well. But Tether's got about a 65% market share of that market. It's around a $350 billion market cap. So that's roughly how many stablecoins are in circulation. But in terms of transaction activity, last year alone, so 2025, there was around 33 trillion US dollars of transaction volume in stablecoins. And that's, for context, that's on par with what Visa is doing. And so we're rapidly seeing a shift from traditional cash that transfers through bank systems to stablecoins because it's just so much cheaper and faster to do.
Is that mainly in the US? Because I know, in Australia, you can transfer between bank accounts with no issues, Westpac to CBA, CBA to ANZ, me to you, whatever it looks like. But in the US, they've got Zelle and all those other types of transaction payment transfer systems because their bank system doesn't allow that. Is that ultimately solving that issue, or is that why it was brought about?
It's a really interesting question, actually. So, as you said, in Australia, we've actually got the new payments platform now. So that was developed in conjunction with a company called Osco. And that allows you to send payments instantly via Pay ID. You can have someone's email address, mobile number. And so long as that transaction's $10,000 or under, typically, depends on the bank, but it's around $10,000 or under, you'll receive those payments instantly. And so Australia's actually got one of the best, banking and payment system in the world for those size of transactions. But if I was to try and transfer you, $100,000, or, I wanted to buy a house and settle into your account, even within Australia, you're looking at, T+2, which is, 2 days to actually have the funds settle in the account. And even if it's just a bog standard BSB account transfer, that still takes a day to 2 days if you're not going through the PayID OSCO system. Going to the US, they've also got, their systems aren't quite as good as we have in Australia. They've rely more heavily on cash apps, Visas, MasterCards to do transactions. But in terms of where stablecoins are really fitting into the picture, it's actually less so domestically in places like Australia, but it's more on international FX and international transfers. There's a huge demand for digital dollars from other countries that maybe they can't open an Australian or US bank account, but they would love to, save in US dollars instead of, for example, the Iranian rial or the bolivar, for example.
Right, right. Well, very, very interesting. So, loaded question. Will it ever, the whole thing when it first came out, people buying pizzas or whatever, and it was like, this is going to take over the Australian dollar and become the next currency. Some of them tried to incorporate and work with banks, one of them specifically. Are we ever going to get to that point?
I think talking specifically about Bitcoin and sort of stable coins, they're very different assets. So Bitcoin is seen as a volatile long-term store of value. And it's appreciated significantly over the last 5, 10 years. As we know, it's had a volatile 12-month period. It's fallen by about 14% in value over that time. We don't, at least from our perspective, we don't see Bitcoin replacing the Australian dollar, US dollar anytime soon in terms of day-to-day transactions. And in fact, the technology underpinning Bitcoin can process around 7 transactions per second. It's very, very slow. So it's just not suitable as a cash transaction settlement network, at least on the Bitcoin blockchain. Now, there are companies like Lightspark that have developed what are called layer 2 protocols that sit on top of the Bitcoin network. And they allow, millions of transactions per second. So theoretically, one day that could be the case, but central banks and governments really do like to have control of the money supply for various different reasons that some of them you'll agree with, some of them you maybe don't agree with, and are a bit reckless with their spending. The short answer is we don't think Bitcoin anytime soon is going to replace dollars, central bank issued currencies. However, we do think that money over the next 5 to 10 years, as we've already seen, is going to shift from traditional antiquated banking ledgers and payment networks onto blockchains. And it's simply because the technology is so much faster and cheaper. It's a superior way to send money internationally. So yeah, I think stablecoins will, but assets like Bitcoin, at least near term, won't.
And digging into Bitcoin, so Bitcoin's the largest crypto digital asset out there at the moment.
Yeah, Bitcoin is, if you think of crypto, or the entire digital asset market, it's around $5 to $6 trillion depending on the day, and Bitcoin is around 60% of the entire market capitalization. So 60% of all of the value is within the Bitcoin network. With that said, most people buy and hold Bitcoin for the long term. So most transactions don't actually happen on Bitcoin. It's a lower volume, higher value, store of value. Most of the transaction activity happens on networks like Ethereum, which the stablecoins we've just been speaking about, they actually issue their stablecoins on top of networks like Ethereum, where it's cheaper to transact. And Ethereum was built as a more programmable blockchain.
Right. So Bitcoin's more investment focused rather than not focused, but used day to day more as an investment for the long term. And there's other digital assets, Ethereum, that might be traded more regularly. Bitcoin, I know, has a finite amount of coins available or blockchains available. And you do hear a fair bit about Bitcoin miners and people trying to mine Bitcoins at home and the like.
Mhm.
Do you want to take us through what that is and if I have a chance of mining a coin at home myself?
Yeah. So actually, when we started BlockByte, we were originally in the Bitcoin mining space ourselves. So around 2020, 2021, China banned Bitcoin mining in their country. And so we are actually acquiring those miners, shipping them over to Norway into a fully renewable hydro facility where, they would run on very cheap electricity and mine Bitcoin. So what exactly is going on with, how does Bitcoin mining work? In order to validate transactions on the Bitcoin network without relying on banks and other third parties, which is, the current banking system, the designer of Bitcoin, Satoshi Nakamoto, had to invent a incentive system that would, encourage people to participate in the network and also to verify transactions. And to do that, you used to be able to, you still can, but you can use your own laptop computer. But traditionally, what people have today is what are called ASICs, and those are application-specific integrated circuit boards, which is a very jargon term for Bitcoin mining equipment. And effectively, these machines make millions of guesses at solving a cryptographic puzzle. And the first one to solve that puzzle is rewarded with a certain amount of Bitcoin. Now, currently, the amount of Bitcoin that gets released is about 3.125 Bitcoin every 10 minutes. And if you wanted to use your computer to try and validate transactions and participate in the network, the chance of you winning would be proportional to how many guesses your computer is capable of making, which is called a hash rate, relative to the global hash rate. And because your laptop or your desktop computer is so tiny in power in comparison to these massive computers that have got, they're specifically built for mining Bitcoin, the chances are very, very slim, although it does still happen occasionally. And so what people do is they group together in what are called mining pools, and you basically get a guaranteed rewards or guaranteed payouts because you share the amount of Bitcoin mined in proportion to how much power you contribute, if that makes sense. So you're kind of part of a pool of
Mm,
compute. That's right.
yeah, you're in a team, so I've got no hope doing it myself. So we'll
Yep.
just come to you to buy some Bitcoin or Ethereum or whatever it is if I so press.
You can join a mining team, but we're out of that business now, and the main reason is, if anyone is looking at mining, Bitcoin themselves, um, you really want to have a look at the economics of that now. So you need next to free electricity, and in Australia, cost of electricity is around 35 cents a kilowatt hour, and you need very powerful machines as well. And so, from an economic standpoint, unless you've got significant resources, mining is generally not the most profitable way to acquire Bitcoin. You're better off just buying it directly.
Yep, cool. So jump onto the market and buy it if you want it rather than
That's right.
mining it. How do you access Bitcoin or Ethereum or any other digital asset if you were to go down that path to purchase?
Yeah, there's actually a few different ways. So one is you've got major exchanges. So your Coinbases, CoinSpots, Binance, SwiftX, I think is one of the larger ones in Australia. Those are great for self-directed investors. You might already have an idea of what you want to buy and what you want to sell. You've then got brokers. So that's players like ourselves, BlockByte, there's Caleb and Brown, Stormrake, Uptrade, to name a few others. The key difference there with the broker is if you're not sure what to invest in, or you're not really, I guess, in digital assets full time as we are, and we provide that more tailored service around buying and selling. The third way you can do it is mining, which we just touched on. Fourth way is through ETFs or exchange traded funds. And so a large company like a Fidelity or BlackRock will buy the Bitcoin on your behalf, and you effectively buy shares in their fund, which gives you indirect exposure to the underlying digital asset. And a couple of other ways are you can buy managed funds where they'll kind of pick various
Mhm.
cryptocurrencies for you and maybe charge a performance fee. And then the last way, which I don't recommend, sorry if there's any ATM owning companies here, but you can buy Bitcoin and other cryptocurrencies through ATMs with cash. But generally speaking, the spreads, which is the actual price difference between what they're offering you the Bitcoin at compared to what it actually is generally pretty significant. So if Bitcoin was $100,000, if you pay into an ATM, they might charge you $110,000 a Bitcoin.
So there are a couple ways to access it much easier these days than 10, 15 years ago, to access it if you did want to. I know, 10, 15 years ago, however long ago, there was all talks about wallets and keys, and if you lost your key, you lose all your asset and all your value. Stories that pop up on news.com and whatnot of the bloke that threw out his hard drive and's been searching the dump for 5 years for his $1 million of Bitcoin. So that's no longer the case.
No, it's still the case. It doesn't need to be the case. Self custody, which is where you are effectively the person responsible for managing what's called the private keys, which is the cryptocurrency equivalent of a password. If you have all of your, Bitcoin or whatever digital assets that you hold on a hardware device, could be a computer. You can buy specific wallet devices that hold your private keys in there. If you lose that device, you effectively lose access to those funds, and they're almost impossible to recover. There are ways to more securely self custody. This is something that we actually do at BlockByte as well. So that's called multi-sig, which stands for multi-signature. So instead of having all of your funds on a device with one key, you can actually create 3 keys, 5 keys, 7 keys. And as long as you have a majority of keys, you can always recover the funds. So let's say you've got one key at home, one in a safety deposit box at a bank, one with BlockByte. You lose one key, or your house gets broken into, you're still able to access those funds. So the key is, don't put all of the crypto tied to one set of keys only. Like, you want to spread that out.
Don't lose the keys, otherwise it's not a great time, I imagine.
Yes.
But before anyone does jump into crypto, if they want to, always, assess the risks, get advice before you invest in crypto, Aussie shares, anything. So just make sure you're all across the risks and the benefits of, everything that can happen in your investment of choice. On to the next part. I guess there's a lot of misconceptions and myths, a lot of generalizations out there when it comes to these assets. Again, I'm talking 10 years ago, but there's a lot of unknowns around what it could and can't be used for, which we're more across these days. So one of the myths is you don't pay tax on crypto or digital assets. It is taxable.
Yep. So I'm not an accountant, but I can definitely guarantee that cryptocurrencies are taxable, and yeah, they're treated pretty much as any other asset when it comes to capital gains tax. As an individual, if you hold it for less than a year, you don't get any sort of capital gains tax benefits, at least from my understanding. If you hold it for more than a year, you get that sort of I think it's 50% discount on the taxable
Yeah.
amount.
Depending on the structure you hold it in and whatnot. But
Exactly.
at some point, you're probably going to have to pay tax on it. The ATO, you know, tighten their ruling where at some point potentially you didn't have to pay tax because it was outside of their scope. Now they're going to hit you with some nice tax. The other one I have here is it's anonymous. Cryptocurrencies, digital assets are completely anonymous, and the only practical use is for criminal activities. That was another myth that we can debunk today.
Yeah, that one's been thoroughly debunked. Chain Analysis, which is one of the biggest called on-chain analytics companies, where they actually dig into all of the transactions that we can see on blockchains. And it's less than 1% of transaction activity is used for illicit purposes. In fact, the biggest illicit use case within that 1% today is sanctioned countries. So it's less like your kind of individual crooks. It's more the fact that major countries like Russia, Iran, China, countries that have been sanctioned, or wallets that have been sanctioned, like North Korean wallets, those are sort of the major players in the illicit cryptocurrency space at the moment. But yeah, it's less than 1% of all of transaction activity.
Yeah, and now you've got, as we said, the exchange traded funds with BlackRock, Fidelity, and a few others out there. It can be used for investment purposes or legitimate transaction purposes if it's appropriate at the time. Um, the other one we've got crypto's unregulated and anything goes.
Yeah, that one's also been debunked for a while, really. So, in most jurisdictions now, crypto is either regulated and sort of accepted as part of the financial economy, or it's banned. In which case, it's still regulated in places like China, but it's regulated in a way that's trying to have less people involved with it. So, in Australia, today, AUSTRAC is the main regulatory body that oversees transaction activity with respect to digital assets and investing. And of course, you've got the ATO as well that looks over things from a taxation perspective, but also ASIC, the Securities and the equivalent of the Securities and Exchange Commission here in Australia, are bringing in new regulations which will come into force from June later this year. And so companies that are offering financial services, financial products, so crypto funds, advice pertaining to crypto, will also be required to have an Australian financial services license, or become a corporate authorized representative of a company with a financial services license. And so whilst the initial reaction might be, "Oh, that's not good," for some of the crypto companies, it's actually a really good thing. And the reason is that regulation is what allows advisors like yourself and other companies who, it's been a bit of a hot potato or a difficult subject to talk about with your clients. Is something that will actually now come under your AFSL, where you'll be able to have these conversations directly with clients and advise on portfolio mixes for digital assets as well.
Love it. And the last one I have here, it's in the name, but we've already kind of just spoken about it. But stable coins are always stable and not volatile.
Yeah, well, they absolutely should be stable, but there was a disaster. I think it was in 2020, around 2020. I could be getting the year wrong, but it's a
COVID.
yeah, around COVID, there was a stable coin called Terra Luna. It was called an algorithmically backed stable coin, which, if you hear that, run for the hills. Effectively, the company behind that, which has gone bust and lost billions in investors' funds, was buying their own internally issued token called Terra Luna, as well as a bunch of other different digital assets, and then issuing a stable coin against that. And so this stable coin was collateralized by highly volatile assets. And so eventually, when the assets that were backing it, namely their own Terra Luna token, went down in value, their stablecoin token lost its dollar peg. And so people started to panic, and then it triggered more sell off of the Terra Luna token and it collapsed. So you don't want to touch those kind of stablecoins. And thankfully, after that incident, we don't really see any activity or transactions happening on those types of stablecoins. The traditional, more mainstream stablecoins now, like USDT or USDC, which are issued by Tether and Circle, those have got tens of trillions of transaction value happening on those tokens every single year, and they are backed by cash or typically short-term government-issued bonds called T-bills. And so those are 30-day duration bonds, and they're redeemable one for one with the token. So those stablecoins are actually pretty stable indeed.
No worries. Thanks for that. And before we wrap up today on our digital assets, Crypto 101, is there anything else that you wanted to add, James, that the people should know?
Yeah, I think the digital asset space continues to grow, even though over the last 12 months there's been price volatility. I think probably important to know as an investor is don't just jump into a specific token because your mate says, "Hey, this one's gone up very very nicely over the last month or two." Take some time to either speak to a broker, speak to your financial advisor who might know the right people who have got a lot of skin in the game and interest in the space. And yeah, I would just say try and learn a bit more before you jump in.
Seek advice, make sure you're across the risks before you jump into any digital asset, any asset, full stop. So that's a wrap for today's episode of the Wealth Builder podcast. Thanks to James for joining me today and helping us understand a bit more about cryptocurrencies and digital assets. Thanks to everyone to listening along. If you liked today's episode, feel free to drop us a message or share it with someone you might know who might find our conversation valuable. But I look forward to bringing you the next episode in a fortnight's time. Until then, have a great day.